So would you like to go first or would you like me to go first about good old Palantir?
I'll go first. I mean, they had a
Okay.
great quarter. They blew it out the park with the numbers. There were some things that analysts kind of came out even before the numbers came out and said, you know what, these are some concerns that we could have in the future. Some of the news that came out earlier that day from Blackstone and from Brookfield, basically, creating two different joint ventures that target Palantir's core market is something that I think the market was slowly digesting after the earnings. And the only negative, and it's not really a big negative, it's just a negative, is a quarter over quarter decrease in growth, right? So they're growing exceptionally fast, but if you look at their growth cadence on a quarter by quarter basis dropped off pretty meaningfully. So if you just look at, let me see if I can find it. I had it pulled up. Sorry, I have the numbers right here. So if you look at the growth cadence, they went from 1.4 billion in 2025 to 1.63 billion. Still great quarterly growth, but it was the first time it went from 19% growth. Like it accelerated last year, 7, 14, 18, 19, and now it went down to 16 last quarter. And then according to their guidance next quarter, it's going to be like 10, like 10% growth year over year. So, I mean, look, this is the law of big numbers, right? Large numbers. This is what you're going to deal with. Like it's harder to keep replicating that kind of growth, and especially over a long period of time. And I think the market, when they saw that, I think there were parts of the market that were just really just like, I don't know how to interpret this, and they took a step back. And I think the markets after hours are taking a little bit of a breather. And there's this saying that Druckenmiller says, and maybe this is something that everyone should at least think about considering. It's that when stocks stop going up during really, really good news, that's usually not a good sign. So just keep that in mind.
Yeah, so I'm gonna probably break some hearts right now, and I'm gonna give it to everybody very straight. And everybody
Mhm,
knows I don't pull punches and I speak my mind. So I
mhm.
asked the question, did you think Palantir's quarter was a drop the mic moment? It's fairly split right now. We got 67 votes. Let's let the poll keep going. I'm going to make a statement that may piss some people off. I think Palantir's in trouble, not from an operational point. Okay. This is the third quarter where it was legitimately a drop the mic moment and the stock could not break out. That tells me that this thing is priced for absolute perfection. And if there's just one little thing that the market seems questionable on, that it's just not going to fly. I think this is going to be very hard to get back to all time highs anytime soon. Now, I think this was one of the best operational quarters I've seen from a company ever. So I made a little slide deck about what I'm looking at. So I want to show everybody a few things. So 1.63 billion in revenue, 84.76%. I was a little high. I said that I thought they were going to do about 86.5% year over year increase. The guidance on the high end is 1.81 billion for Q2. They're guiding on the high end for a year over year increase of 80.33%. So I do think they're going to come in with 83 to 85% next quarter. And I'll show you why in a sec. Now, for the year on 2026, they're saying 7.66 billion on the high end. And look, when I look at the revenue, this is an S curve happening. This
Mhm.
had 10 to about 10 quarters of just very gradual increase. And the last 5 quarters are just gangbusters. Now, year over year increase on the high end for 2026 fiscal year, $3.19 billion. They're talking about 71.18% year over year growth. This is also not a small company. That growth is very meaningful. Now, the deals over 1 million was very telling. The biggest quarter ever for deals over 1 million. 139 year over year increase to 206. They increased by 67 deals, 48.2%. The deals over 5 million increased by 51 to 72, from 51 to 72. So 21 deals an increase by 41%. And then deals over 10 million increased by 16 deals, 31 to 47, over a 50% increase in very large scale deals. Customer count increased by 238 customers year over year, 31%. And then on the profits, and I'm going to call Palantir out about something. Stop using adjusted free cash flow, for the love of God. I complain about this every quarter.
Just scroll in.
You don't need to. I'm actually asking Claude to clean it up and make it look a little better.
Mm-hmm.
But the crux of it is 899 million free cash flow, 55% margin, 870 million net income, 53% margin. Incredible margins. Stop using adjusted free cash flow. I hate that number. Don't add back in your payroll taxes. Like, what are we doing? Just give us straight free cash flow like everybody else. Share-based compensation.
Hold on, before you do that, do you ever strip out the interest increase, the interest income from their cash pile?
For the net income,
No, for free cash flow.
I mean, for free cash flow, I just go, I'm calculating it as simply cash from operations minus CapEx. I'm stripping everything out that they add back in, because they report adjusted numbers and I hate it.
Yeah. The reason why I'm saying that is because right now it's fine. It's helping the margin case. You know, when they highlight the margins that they have, typically what happens is they have this boost that comes in with interest income, but over time it's going to become lower and lower that boost helps you, you know, because
100%.
Number one, there's two things. Number one, if we get rate cuts, all the treasuries that they're rolling over are not going to give you the same rate of return. And number two, as your revenue is growing, it's just that money that you're getting is going to become a smaller and smaller piece of your cash. So what ends up happening is your operating cash is going to look like, your margins are going to look like it's a little bit down. So
yeah.
Sorry.
Now, share-based compensation is the lowest percentage of revenue it's ever been since they've been a public company, 12.34%. And it is basically staying flat while revenue is skyrocketing. So I am not mad at the stock-based compensation.
Yeah.
Where I'm at on this company, cash pile's huge. Obviously, they're not deploying cash for a reason. It's more advantageous for them to keep it in short-term treasury bills for the moment. If this stock falls and if the market takes it down, I want to see them do a big buyback. And I don't know if it's in their best interest right now, but this quarter was spectacular from a business operating perspective. The guidance is incredible from a business operating perspective. The question is, when we get out of this year and we get real comps, because now they're not going to be in 2027 starting off of a very low comp year. You're now over $1 billion. You know, you're at 1.6 rather than 883 million on Q1. That's going to be a pretty hard comp to get over 50% growth on, in my opinion. Now, maybe they do next year, but the growth rate is going to slow. I don't think that they're going to have another year of 70% or more growth going forward. It's just going to be much harder off the comp base. And I think that the market's going to realize that. They're in their mega growth spurt right now. And if they can't break out off these numbers, I don't know what the hell they have to do it. Now, take the valuation number out of it. We all know the valuation's high. But you come out with 80% more or more, to me, it tells me this thing is going to have a very hard time getting back to 200.
I mean, just look at Nvidia. You think Nvidia had bad earnings,
right?
But the market is not looking at it from today. The market is saying, I'm looking forward. and I see the growth slowdown coming. And there's competitive threats that are emerging also. I mean, I think it's worth looking at least to get an idea.